the coming stock market crash, and what people are saying about it. In the realm of global finance, apprehensive whispers and speculative discussions have been gathering momentum, foretelling a potential storm on the horizon, the looming prospect of a stock market crash. As market analysts and enthusiasts peer into the intricate web of economic indicators, historical precedents, and geopolitical factors, contrasting perspectives emerge, each attempting to decipher the signs and portents. While some voices resonate with cautionary tales of impending financial turbulence, others emphasize the resilience of modern markets and the lessons learned from past crises. As the discourse intensifies, a cacophony of opinions swirls, shaping the narrative of what may lie ahead in the complex realm of stocks and trading. In this milieu of uncertainty, opinions diverge, but one thing remains certain: the enigmatic future of the stock market continues to captivate and intrigue the global financial community. In the realm of global finance, the specter of a forthcoming stock market crash has ignited a fervent discussion among economists, investors, and financial pundits. As economic indicators oscillate and historical parallels are scrutinized, a range of opinions has surfaced, each contributing to the mosaic of uncertainty that surrounds the topic. Among those who predict a looming crash, a common argument revolves around the notion of market overvaluation. Some experts assert that stock prices have outpaced their intrinsic values, creating a potential bubble that, once burst, could trigger a significant correction. They point to metrics such as the price-to-earnings ratio and the cyclically adjusted price-to-earnings ratio, highlighting their elevation compared to historical averages. This perspective warns that such imbalances typically lead to market downturns and even recessions. Another concern voiced by those anticipating a crash is the trajectory of interest rates. As central banks signal shifts towards tightening monetary policy, rising borrowing costs could hamper corporate profitability and consumer spending, ultimately dragging down stock prices. The possibility of inflation gaining momentum further fuels these concerns, as it could prompt more aggressive interest rate hikes and erode purchasing power. However, not all voices join the chorus of alarm. Optimists argue that market corrections are an inherent part of the economic cycle and shouldn't be conflated with an impending crash. They emphasize the lessons learned from past crises, such as the 2008 financial meltdown, which prompted regulatory reforms and improved risk management across the financial sector. These voices contend that while short-term volatility might occur, the underlying strength of the modern financial system and the agility of central banks could mitigate the extent of any potential downturn. In the age of rapid information dissemination, media outlets play a significant role in shaping public sentiment. Sensational headlines and clickbait narratives often stoke anxiety, contributing to a climate of speculation and unease. On social media platforms, a whirlwind of opinions, forecasts, and conjectures circulate, creating a cacophony of noise that further muddles the discourse. As the debate rages on, investors and the general public grapple with the problem. Whom to heed in the cacophony of perspectives? While no crystal ball can accurately predict market behavior, the diversity of viewpoints underscores the intricacies of financial markets and the complexities of human psychology that underpin them. In this environment of ambiguity, one thing is sure: the discourse about a potential stock market crash will continue to captivate attention and spark impassioned conversations. Many investors and individuals are heeding the warnings of experts who predict a crash. They're adopting cautious strategies, reducing their exposure to high-risk assets, and reallocating their portfolios to safer options. Some are even considering reducing their overall investments to avoid potential losses. Not everyone is convinced of an imminent crash. Some individuals are skeptical of the predictions, citing the market's resilience in the face of past challenges. They believe that the current fluctuations are part of the market's natural cycle and that the global economy's recovery will prevent a severe crash. Some investors are taking proactive steps to brace themselves for a potential downturn. They're diversifying their portfolios across different asset classes, including bonds, commodities, and real estate, to mitigate the impact of a stock market crash on their overall wealth. A significant portion of investors and financial professionals are closely monitoring economic indicators, corporate earnings reports, and global developments. They aim to stay informed and make agile decisions based on evolving market conditions, rather than making hasty or fear-driven choices. On the flip side, a sense of fear of missing out, FOMO, can lead some investors to make impulsive decisions. They might jump into high-risk assets in an attempt to capitalize on potential gains before a crash occurs, potentially exposing themselves to greater risk. That's all for today. Make sure to like the video and subscribe to the channel for more videos like this. What do you think about this market crash? Let us know in the comment section down. Until next time. Thanks for watching.